Silver is trapped. 30% up from the bottom, 30% down from the top. Perfect symmetry, perfect balance. Or at least that's what the chart wants you to believe. At first glance, the market looks calm, stable, controlled. Silver sits near 82 per ounce on Western exchanges. Bulls feel validated because price bounced from the lows. Bears feel justified because it rejected the highs. Volatility has compressed. Daily ranges are tightening. Technical traders are drawing clean lines, support below, resistance above. Everything appears orderly. But markets rarely break when they look chaotic. They break when they look stable. Beneath this calm surface, something fractured. And most people will not understand what broke until the consequences are already visible in price. If you come from a world where numbers matter more than noise, then this matters. Because what is happening in silver right now is not about hype or emotion. It is about structure. It is about arithmetic. And it is about confidence. Silver rallied from roughly 63.90 to nearly 93, about a 30 move higher. Then it corrected down toward 82, roughly a 30 decline from the peak. Mathematically elegant, symmetrical, balanced. This is what traders call equilibrium. A price zone where buyers and sellers temporarily agree on value. But there is equilibrium, and then there is an equilibrium trap. True equilibrium is healthy. It reflects real supply meeting real demand at a sustainable level. Both sides are comfortable. The market breathes normally. An equilibrium trap looks identical on the surface. Price stabilizes. Volatility shrinks. Participants relax. Risk feels low. But underneath, structural stress builds quietly. The trap forms when visible stability hides invisible imbalance. When participants mistake the absence of movement for the absence of danger. Commodity markets do not remain balanced when pressure builds underneath. They remain balanced until the pressure exceeds the structure. And when they break, they rarely drift slowly. They gap. They surge. They dislocate. Silver now sits exactly at that inflection point. On a quiet February trading session, approximately 5 million ounces of registered silver vanished from vaults tied to the COMEX. Not sold into the market. Not simply reclassified. Withdrawn. With that withdrawal, registered inventory fell below 100 million ounces, now sitting near 98 million. That threshold has not been breached in the modern era of detailed commodity tracking. To understand why that matters, you have to understand how the warehouse system works. Silver stored in COMEX-approved vaults is divided into two categories, eligible and registered. Eligible silver is metal sitting in the vaults, but not pledged for delivery. It belongs to private owners who may never intend to sell. It can remain there indefinitely. Registered silver is different. Registered silver is available to satisfy delivery demands against futures contracts. It is the physical metal that backs the paper promises traded on the exchange. For years, registered inventory fluctuated comfortably above 150 or even 200 million ounces. There was cushion. There was margin for error. Confidence had room to breathe. That cushion is gone. Now apply simple arithmetic. March open interest stands near 65,000 contracts. Each contract represents 5,000 ounces. That equals 325 million ounces of paper claims. Registered inventory stands near 98 million ounces. That is a 3.3 to 1 ratio. More than 3 ounces of paper claims for every single ounce of registered metal available for delivery. Defenders of the system will argue, correctly, that most contracts do not go to delivery. They settle in cash. Traders roll positions forward. Historically, only a small percentage demands physical metal. But the system depends on confidence. It depends on the assumption that if delivery is requested, the metal is there. What happens when that assumption begins to weaken? February 27th marks first notice day for the March contract. On that day, contract holders must declare their intention, cash settlement or physical delivery. Historically, 2 to 5% of contracts proceed to delivery. Occasionally more, rarely above 10%. Now stress test the numbers. If 15% of open interest demanded delivery, that would equal 9,750 contracts. Multiply by 5,000 ounces and you arrive at nearly 49 million ounces, roughly half of total registered inventory claimed in a single month. And April, May, and July contracts already sit behind March in the queue. This is not speculation about some distant crisis. This is arithmetic applied to publicly available data. 325 million ounces claimed. 98 million ounces registered. 14 days to first notice. And here is what makes it different. The inventory collapse happened while price was calm. There was no panic, no spike, no headlines screaming shortage. Someone, or several participants, looked at 82 silver and decided physical possession mattered more than paper exposure. They withdrew metal while the chart looked balanced. The fracture did not appear on the price chart. It appeared in the vault. Meanwhile, the Silver Institute recently projected another annual deficit. On its own, a 67 million ounce deficit may not sound dramatic. Global production is roughly 800 million ounces per year. 10% shortfall seems manageable. But this is year 6 of consecutive structural deficit. Year 1 of deficit is noise. Year 2 is adjustment. Year 3 thins inventories. Year 6 is depletion. Stack 6 years of similar gaps, and the cumulative shortfall approaches 400 million ounces. That metal did not appear from nowhere. It came from above-ground inventories, stockpiles built during prior surplus years. Visible global silver inventories total roughly 2 billion ounces. Annual demand now exceeds 1.2 billion ounces. At current consumption rates, visible inventory represents less than 2 years of global demand, and that assumes zero growth. Industrial demand is the critical variable here. Solar panel production consumes over 130 million ounces annually. Electronics require over 200 million. Electric vehicles use substantially more silver than internal combustion engines. Charging infrastructure requires high-conductivity contacts. Medical and antimicrobial uses add further demand. Silver is not simply a monetary metal. It is an industrial necessity. And most silver production is a byproduct of copper, zinc, and lead mining. That means supply cannot quickly ramp in response to price signals. The supply curve is relatively inelastic. Demand grows steadily. Supply grows marginally. Deficits persist. At the same time, Eastern physical markets are trading at persistent premiums. Shanghai physical prices have traded several dollars above Western spot prices. That divergence signals something fundamental. Physical buyers are willing to pay more for real metal than Western traders are paying for paper exposure. Paper traders see resistance levels near 85. They watch moving averages. They see failed breakouts and weakening momentum. From a technical standpoint, their analysis is logical. Physical buyers see 6 years of deficit, collapsing registered inventory, and a 3.3 to 1 paper-to-physical ratio. They see asymmetric risk. 2 groups, 1 market, completely different interpretations. Now consider the asymmetry. If silver falls 30% from 82, price reaches the mid-50s. At that level, industrial users accelerate procurement. Investors recognize historical value. Physical demand intensifies. A structural deficit at 57 would likely trigger aggressive accumulation. But if silver rises 30% from 82, price moves above 100. At that level, short covering accelerates. Delivery pressure intensifies. The paper-to-physical ratio becomes increasingly uncomfortable. Premiums widen. Confidence is tested. Downside appears bounded by industrial floor demand. Upside appears nonlinear due to structural constraint. This is the equilibrium trap. The first move could look technical. The second move could look structural. And structural moves do not behave linearly. Timing now compresses everything. First notice day approaches. Industrial restocking cycles approach. Seasonal solar installation demand increases. Currency volatility influences commodity pricing. Independent variables begin converging within a narrow window. Markets rarely send formal invitations before repricing risk. They adjust suddenly when confidence shifts. For industrial users, this means modeling procurement risk not as a gradual 5% increase, but as a potential 20 to 40% spike within a quarter. For portfolio managers, it means recognizing that symmetric charts can hide asymmetric outcomes. For observers of broader financial systems, silver represents a small but visible example of what happens when leveraged paper systems meet physical constraint. The equilibrium at 82 looks calm, perfectly balanced between 2 narratives. But balance in price does not guarantee balance in structure. Registered inventory sits below 100 million ounces. Paper claims exceed 325 million ounces. 6 years of structural deficit have drawn down stockpiles. First notice day approaches. These are not predictions. They are current conditions. Equilibrium traps never announce themselves clearly. They appear safe. They compress risk. They reward complacency. And then, suddenly, they don't. The question is not whether silver moves again. It will. The question is whether the next significant move reveals that the real break already happened, quietly, inside the vault, while everyone was watching the chart. Because once confidence shifts from assumption to doubt, price does not drift politely to a new level. It jumps. And by the time the jump is obvious, the equilibrium that once felt safe will be remembered for what it truly was. A temporary pause before structural reality asserted itself.